They're a reseller that does a little fix up on the house. They use big data. They use technology, source the best houses and look at the market and see which are the right houses to buy and when, which you've seen because of COVID. You've seen a flight from the urban city to suburbia. Banks are flying you around on private jets, whining and dining you. Oh man, this is so cool. I'm the CEO, flying around on private jets and meeting with all these investors. Believe me, you're paying for that private jet.
We've actually covered Opendoor many times on the show. Opendoor is also a linear business. So, despite these articles, right? I mean, they love to just throw around they love to throw around the marketplace word. Here's CNBC. Not even going to try and pronounce Chamath's last name. But anyway, his SPAC is going to acquire Opendoor, an online marketplace for buying and selling houses. This is incorrect verbiage, Leslie Picker from CNBC. Incorrect. They're not a marketplace. They are a linear reseller of houses. Doesn't mean you can't have a good business. Doesn't mean you have a bad business. It's just not a marketplace. It's not a platform. They buy houses and then they do some fixing up on them and then they resell them. They are a reseller. They're a reseller that does a little fix up on the house. They use big data. They use technology to source the best houses and look at the market and see which are the right houses to buy and when. They put some money into them to fix up the house. And then they have technology that streamlines the whole, buying and selling process, like transferring titles and all that kind of stuff, which is actually somewhat time intensive and labor intensive. They have process and tech for that. But at the end of the day, their business is to sell the houses at a higher price than what they bought them for, plus whatever money they put into the house to fix it up. We spoke about Opendoor because they have the partnership with Redfin, which is an actual platform in the real estate industry, connecting buyers and sellers, agents and buyers, like a Zillow. And so Zillow, also a platform, Zillow in Plat. And Zillow had Zillow Offers, which is basically the same thing of Opendoor, right? It's the linear model, right? It's saying, I'm a platform, Zillow or Redfin. I have all the data on what people are selling and buying, and I'm going to be able to find good houses, offer those homeowners offers to buy the house, fix it up, and then resell it. And because I have the best data as the platform, I should be able to make really good margin on this linear buying and reselling activity of houses. That is the thesis for Zillow doing Zillow Offers, which they paused with COVID. Opendoor similarly they had to take out a bunch of debt in March. Despite all of that, and you would have thought that home prices would get hit pretty badly in COVID. And I think actually what we've seen, depending on where they own houses, but I think most of their houses were actually in areas, suburban areas around a metropolitan center. So actually what you've seen because of COVID, you've seen a flight from the urban city to suburbia. Here in Fairfield County, outside of New York City, Fairfield County is popping. Homes are flying off the shelf. Homes are getting listed and literally selling the same day. People are just fleeing big cities. And so you have this huge flight to suburbia, which actually means that, maybe if they had held on to some of that inventory that they had going into COVID, they probably could have made an even better margin on it. But what's interesting is, so this company, apparently, Opendoor, is valuing itself at $4.8 billion. Which they, at their last fundraise, was valued at $3.8 billion. And that was in February of 2019. So they're adding about, a little under a third, another $1 billion to their valuation. They raised $1.5 billion in debt in March of 2019, and they'll use that debt to finance a lot of their acquisitions, right? Because I'm buying the house and then I'm reselling it, so They'll be able to use that debt to help flip these houses. They're basically just flipping houses, right? So they had a $1.5 billion line back in March of 2019. They raised $300 million in equity capital back in February of 2019 at a post valuation of $3.8 billion. Now rumored to be going this reverse merger. A SPAC is, if you want to think about what a SPAC is basically an entity that is listed, and then it is going to acquire you can have SPACs that basically are here to acquire private companies and then make them public. The reason why you do that is because you can expedite and fast track a lot of the scrutiny and filing requirements that would go into doing a normal IPO or direct listing process. So by doing this with Chamath's SPAC, Opendoor is still going to raise capital for the business, similar to what you would be doing if you were accessing and doing an IPO. You're raising equity capital, you're selling shares on the public market. This is saying the SPAC is basically going to finance the capital raise, and the SPAC is buying the business and then listing those shares publicly. And Opendoor gets to still get capital and then sidestep a lot of the traditional disclosures and reporting. I mean, you still have to have disclosures. You're a public company, but you don't go through the same process of needing to get, banks and other investors to bankroll your IPO. So it's not that traditional kind of roadshow IPO model, which for some companies can make sense for them. Airbnb apparently was trying to be was being approached by Bill Ackman's SPAC to do something similar with Airbnb and help Airbnb go public in this model. The other nice reason why a lot of these companies want to get public, even if they don't need or want to raise a lot of capital, that's where you see companies entertaining direct listings, where the company says, well, I don't actually need to raise new capital, but I would like to give my investors, my shareholders, my employees that have options liquidity. And so now it's basically just saying you're going to do a direct listing, and now the shares can be traded on the stock exchange. So you're bringing liquidity to your existing shareholders, and you could do a fundraise in the future. You could issue new shares and then basically sell stock to raise capital in the future once you have done a direct listing. But in the direct listing model, you're not actually raising new capital in that process. You're really just kind of accessing the public markets and providing liquidity to your existing shareholders. There's also a lot less fees on the direct listing. The investment banks, they take their pound of flesh when they take you public through a traditional IPO process. You know that saying? It's like you buy a Range Rover and the Range Rover comes with nice luggage in the trunk, and then you hit yourself in the head and you're like, damn, I just paid like 5x retail value for that luggage. I didn't really need that luggage. I didn't really want that luggage. Damn. That's the feeling with the IPO and fees, but just in a much bigger way. Instead of it being luggage in the back of your fancy Range Rover, it's now private jets. And the banks are flying you around on private jets, whining and dining you. Oh man, this is so cool. I'm the CEO, flying around on private jets and meeting with all these investors. Believe me, you're paying for that private jet. You're paying 5x or more for that private jet and all the private jet trips and all the other things that happen in the IPO process. The investment bank isn't just giving you free private jets. That money is coming from somewhere, and it's coming from the exorbitant fees the investment bank is charging you. Anyway, let's get back on topic. Back to Opendoor. Yeah, that's what we were talking about. $3.8 billion. So they're adding another $1 billion to the valuation. That's at least the plan. Things can change, but another linear business, and actually a linear business that you might have thought at first blush would be hurt by COVID. I actually think there could be the opposite here, where you actually have these tailwinds that are, that have been brought about by COVID with people moving to suburbia. So this could be interesting, and I actually think could be a really strong linear business. We've seen this in cars, where you have big businesses, public businesses. I think Vroom might be a good example of this, where they are buying and reselling cars, right? You buy a car used, you might fix it up a little bit, and then you resell it. In these massive industries where the car industry is $1 trillion industry, the housing industry, probably bigger than that, massive industries. All you're saying is, I'm just going to use digital and tech and data, and I'm going to optimize a reselling function on one sliver of that market. And even though it's a small sliver of the market, it's $1 trillion market or more. And if I optimize that sliver of the market, I could have a multi-billion-dollar business. I think that, one example of that in cars would be Vroom, and now, Opendoor being kind of the example of that in housing. So 2 interesting models here. Linear doesn't mean bad business, but important to understand the difference when you look at their multiples, their ability for, their profitability path, and all these kinds of things, defensibility, all that fun stuff. Hi, this is Alex from Winner Take All. Thanks for joining us. Hope you enjoyed the content. Feel free to leave a comment, ask us questions, and definitely make sure to join us on our next live stream.